Crypto trading has become a popular way to invest and make profits in the digital currency market. It involves buying and selling cryptocurrencies like Bitcoin, Ethereum, and Litecoin. To get started, you'll need to understand the basics of blockchain technology, which is the underlying technology behind cryptocurrencies. You'll also need to learn about different trading strategies, such as day trading, swing trading, and long-term investing. It's important to do thorough research and stay updated on market news and trends. Finally, choose a reliable exchange platform and start practicing with a demo account before diving into real trading. Crypto exchanges are platforms that facilitate the trading of cryptocurrencies. They allow users to buy, sell, and exchange digital assets for other digital assets or fiat currencies. These exchanges operate 24/7, providing a global marketplace for trading. They offer various features such as order books, charts, and trading pairs. Security is a key aspect of these platforms, as they store and manage users' digital assets. They employ various security measures, including encryption, cold storage, and two-factor authentication. Fees are charged for trading on these platforms, which can vary depending on the exchange and the type of transaction. Understanding the different types of crypto exchanges, such as centralized and decentralized, is crucial for users to make informed decisions about where to trade. Trading strategies are essential for success in the financial markets. One basic strategy is trend following, which involves buying assets when they are going up and selling when they are going down. Another strategy is mean reversion, which assumes that prices will eventually return to their historical average. This strategy involves buying when prices are low and selling when they are high. Diversification is also a key strategy, which involves spreading investments across different assets to reduce risk. Finally, stop-loss orders can be used to limit potential losses by automatically selling an asset when it reaches a certain price. These basic strategies can help traders make informed decisions and manage risk in the markets. Trading strategies are essential for success in the financial markets. One basic strategy is trend following, where you buy assets when they're going up and sell when they're going down. Another strategy is mean reversion, where you buy assets when they're undervalued and sell when they're overvalued. Diversification is also important, as it involves spreading investments across different assets to reduce risk. Finally, stop-loss orders can be used to limit potential losses by automatically selling an asset when it reaches a certain price. These strategies can be combined and adjusted based on individual risk tolerance and market conditions. Risks are inherent in every business and personal endeavor. They can lead to financial loss, reputational damage, or even physical harm. Risk management is the process of identifying, assessing, and prioritizing risks to minimize, monitor, and control the probability and impact of unfortunate events. It involves a systematic approach to deal with the uncertainty of future events. Effective risk management can help organizations to achieve their objectives, reduce costs, and increase efficiency. It also helps in making informed decisions by understanding the potential consequences of various actions. In conclusion, managing risks is crucial for the success and sustainability of any organization or individual.